This session is entitled Plenary Discussion Modelling Business Cycles, and it's kind of very much in all of your hands. I've got a little bit of input to offer, building on some things that Paul said, and then perhaps if Paul would like to respond to see any linkages that there might be, and then we'll see where we might go from there. But I've honestly no idea what we might end up with in this session, so let me kick off and we'll see where we go. Modelling boom and bust cycles is something that we have done in system dynamics. We tended to do it at the industry level. What do we know about cyclical industries? And the bit I'm particularly picking up is Paul's comment that most recessions are triggered in the corporate sector. That's where signs of things going backwards rather than forwards tend to arise first, and the size of the recessions tend to be greater in the corporate sector than in the consumer sector. So the corporate sector can drop by, well, would you fill in the kind of numbers, Paul? It's kind of 3 times as bigger in the corporate sector than the consumer?
Roughly, yeah, but the fluctuation.
Yeah, so you get much bigger fluctuation in the corporate sector than the consumer sector. So why is that? Well, there are notoriously cyclical industries, and that cyclicality tends to arise when you have various conditions coming together. So if there is a delay between the decision that you want more capacity and actually getting it, that is an important feature that causes cycles to happen, especially if that capacity comes in big lumps. Like an oil refinery is a significant fractional addition to industry capacity. That's the kind of thing. And on top of that, there are 2 mechanisms in particular that make this issue worse. If the industry is producing a consumable product, if that product can get stocked in inventory, either at the producer or downstream, then that inventory will exacerbate the cycles. And it gets worse if you also have to rely on investor confidence being built up before they will lend you the money or approve the money for you to make the capacity expansion. And I just offered a list there of some of the sectors where cyclicality has been observed. And if I'm not much mistaken, it seems to cover most of the economy, right? In one form or other, all of those industries have this problem. And it's quite extraordinary how widespread it is and how kind of almost endemic it is to the capitalist system. The one I happen to know very well is petrochemicals. That's where I started my career. I can still remember in 1975 sitting in a room in Shell Centre over here trying to get approval to build a new polyethylene plant. The new polyethylene plant would have been about a 5% addition to West European polyethylene capacity. And I can remember, going back to Paul's comments about sentiment, I can remember to this day the person who was objecting to this investment arguing almost in the same sentence that we shouldn't build the plant because nobody else was building plants. And that we shouldn't build the plant because everybody else was building plants. Actually at the same time, so very much a kind of sentiment-driven thing. I've got a couple of examples here, and we're going to come to this question, why is it that it might start here? And this is not what you might think of as a cyclical industry, right? This is Starbucks. But that's their profitability. Why did they do that? Not everyone in their sector did. If I put Costa Coffee's performance on that same chart, it would not have shown that feature. During that period there, the early part of the decade, they pushed up their prices. Why did they push up their prices? Because they could. Because demand was so strong, they could always get away with putting another 5 cents on a latte, right? And also because they added 800 too many stores. They operate about 15,000 stores worldwide. How do I know they opened 800 too many? Because they shut 800. And an interesting point to note is that that 2% margin there is worth 200 million a year, that year, that year, that year, and that year. So in those 4 years, they made $800 million more money by pushing the prices up to their customers, which they then threw away by opening stores that the customers didn't want. Right? Should they have known about this? Well, yes, they should, because in 2001, McDonald's made exactly the same mistake. And it was very widely publicised, and it was in the McDonald's annual report that should have known that this. Why did they do that? Well, because of this constant pressure from analysts to beat whatever it is they think you should do. So they keep on trying to do better. Investors want to know where we're going from here, because we're getting back to the link back into the financial sector now. Where should I put my money? Should I lend money to this company to expand? Just a little side note here, there is no requirement. There's a professional association of investment analysts called the Chartered Financial Analysts Institute. It's got, I think, about 40,000 people have gone through its 3-year certification program, which includes 3 stages, I think, of examinations. And there is no requirement in that curriculum for investment analysts to learn anything about the link between strategy and performance. I think it's 1 slide on forces by forces, and that's it. So how are analysts making judgments about where those numbers are going? I don't know. Here is a couple of examples. This is some rather old data I've got about the revenue and volume in the DRAM, computer memory industry. You'd find that in many other kind of similar types of sector. And if you want a really extreme example, this is the gross tonnage of shipping completed by the world shipbuilding industry running up to 2009. You can see lots of wobbles here, lots of little cycles, and then this great big one here. Why did that happen? Well, in 2003, you can see charter rates of 15,000 a day for one class of vessel, rocketed to 300,000 a day at the peak, and now we're back at 2003 levels. So, getting back to the point about the rational actor here, when you're getting that kind of money for renting a ship, what are you going to do? Buy more ships. Who's going to buy more ships? Everybody's going to buy more ships, right? So, but there must come a point, getting to Paul's kind of pendulum thing, where someone up here has got to be saying to themselves, why on earth are we doing this? This has got to be mad. This has got to be madness. But of course, after this, what happens is that the rates collapse, shipbuilding collapses, and then there's a capacity rationalisation takes place where old capacity gets scrapped. Basically, you bring the thing back to balance. Fortunately for this industry, the Chinese economy and so on has been piling on ahead again. So most of those ships were, at the end of last year, sitting outside Shanghai harbour with nothing to do. I think they're mostly employed again, doing something. So let me just illustrate what a system dynamics model would say about where cyclicality like this might come from. Before I show this one, I should refer to a paper in the McKinsey Quarterly entitled Managing Cyclicality in Basic Materials. It's based on work in the petrochemicals industry. And it basically does this. This is what it does. There is an industry capacity. This is over about a 10-year time horizon. And this capacity is adjusting to a steady increase in demand. Now, when I was sitting in Shell Centre trying to help make these decisions, we were absolutely convinced that the cyclicality in our profitability was exogenously driven. We were absolutely convinced we were at the mercy of GDP. If GDP went down, then sooner or later it would stuff demand for our product. But what this shows is you don't need any variability at all. All you need is for it to increase. Right? If it's increasing at almost any rate, any non-zero rate, then there is the likelihood that this will happen. So, as time goes by, let's take this first bit. We've got a shortage, so prices rise to very high levels, and they stop rising when elasticity of demand basically chokes off demand or substitutes take over. Right? So if oil gets too expensive, people start using gas or whatever. Right? That peak in price drives up industry profits, and compared with the capital employed, gives rise to very high rates of return on invested capital. And the numbers can get very high because you get very big peaks in prices, as we saw with the ships, and you have depreciated your old capital. So the capital employed has actually you see the capital employed is actually quite low, gone down here, but the prices and profits have gone up. So you've got a real peak in return. And that triggers everybody buys ships, right? So everybody buys ships. So they call up the shipyard and say, I want a ship. The shipyard starts making it. We've got capacity in construction. And then a period later, the capacity comes out and gets added to the capacity that's in place. Right? Problem is that a lot comes out and it pushes us into surplus. So we've now got redundant capacity hanging around with not enough demand to fill it. And guess what? Prices collapse. That's a kind of simple system dynamics model of a cyclical industry. And that period there is about 5 years. But I've only got a construction delay in here of 1 year. If you're thinking, shall I go exploring the Arctic for oil, it's going to be slightly longer than 1 year between your decision to start exploring and your actual success in finding and exploiting it. Okay, so that's why this is quite a short cycle. The other point about this is that if this is the demand for one product, let's say this is the demand for ships, this number here is actually the demand for the industry upstream. So you get cyclicality pushing back up the supply chain. And in system dynamics sense, that's kind of easy. That's the beer game. But except here, this is in construction and supply, not in physical production and demand. So what I think we might wonder is if recessions start in the commercial sector, in the business sector, and work on out from there, how does this fit into the kinds of models that Paul's looking at? And how does it fit into the wider economy? I just took a couple of notes about some points that Paul made. Firstly, sensitivity to small events. You would only need to knock 1% or 2 on or off the demand number over there at a particular point in the cycle, and it could trigger really quite substantial changes in behaviour background here. So this model should, I haven't tested it, but it should be sensitive to small events. So it's the kind of butterfly flapping its wings issue. You get a very small perturbation here, and all of a sudden everything gets sent into a different state, particularly if everybody's expecting this to go a certain way. And another point, I don't know if I got this right, Paul, but I didn't see anything in the agent-based model where the agents were responding to the success of their own choices.
No, just make a choice.
They just make a choice. Okay. Well, in these cases, these agents definitely respond to the success of their own decisions. There was a study of the pulp and paper industry, and there was one outstandingly successful company, I think a Swedish company, in pulp and paper. And they had discovered how to manage this cycle for their own corporate best interest. Any ideas how they did it? If you were a player in this industry, how do you win when everybody else is losing? Exactly what does doing the opposite mean? You build capacity when everybody else isn't. Yeah. But no.
You buy this capacity.
Yeah.
by other people's circumstances. They just not
it's
down prices.
Exactly. It's exactly that combination of things. What they do is during this period here, they just stick all the money in the bank. Right. And squirrel it all away. They take every ounce of profit they can. If they can do simple debottlenecking things on their plant to give them a little bit, a little 5% increase. They'll do that. Take the money. Then when this happens here, they look around for some individual in the industry who's actually down here somewhere. They either buy the company or they buy the assets off the company. And the other thing they do is they rationalise out the surplus. So they go over here and they say, look, we've got ourselves in a situation where there's 10% excess capacity. I have now bought up a lot of that. I'm going to close the most inefficient capacity in my business, which leaves me with more efficient capacity than anybody else has got. So that's kind of how smart operators behave here. But I think if we look at examples like the subprime mortgage fiasco, the problem was that no one had been there before, which is a new phenomenon. So how was anybody to think that this is something they should do? And it also says something about longevity of leadership, because the Swedish company was led by the same chief executive for 20 years, I think. Right? And if you stay in post for 10, 15, 20 years, you get wise, right? You've seen it before, you know what to do. An interesting feature of the banking crisis was how many of the CEOs had actually not been in banking for their entire careers.
And weren't bankers.
And weren't bankers, yeah, exactly.
For a start.
Weren't bankers. So I think that's really all I have to offer as by way of a contribution to the discussion. So I don't know, Paul, if you've got any thoughts on how this might connect into a wider model of the economy, or are we completely on a different page here?
Well, I mean, you're right. I mean, in a sense, it's that the key thing is that people's expectations aren't fulfilled. The system's sufficiently complicated that they don't learn.
Right.
Because presumably if everybody had complete knowledge of this model and agreed that that's how it operated, they could then modify their behaviour.
Yeah.
But they can never gather that amount of information.
Well, that's an interesting point. What information in this diagram is not known? Because you know demand, you know the supply-demand balance, you know the prices, you know your profits, you probably know or can at least estimate quite well your competitors' profits. And because these are quite large investments, you know when other people are building capacity because they've ordered it. And the people who add the capacity, the contractors, they're very pleased to announce that they've won an order from Shell to build a new petrochemical plant.
Just to think, leaving aside the financial sector, there is, it's a very obscure paper on how the industrial structure itself leads to inherent fluctuations. There's something called an input-output matrix, which describes the production relations in the economy. So here's industry one. How much of its inputs come from itself, from industry 2 and so forth, down to industry N, and how much of its output goes across industries. And there are regular estimates made of these. And so inputs go in and translated through this matrix into the new set of outputs.
Right.
But this matrix, you can easily set up a simple dynamic system. But because it's this matrix, the relations of production are non-symmetric. It's a square matrix. The eigenvalues in general will have non-zero or imaginary parts.
Right.
So the structure of production, might inherently cause cycles.
Right.
Because they're not all supplying. The matrix isn't symmetrical. I'm supplying a bit to you, but a lot to you. You're supplying a bit to and so it's that itself. It's when it cascades into other industries.
Right.
It's got these knock-on effects purely through nothing to do with finance, nothing to do with expectation, just the structure of production.
Right.
So I think this is an important insight. I mean, this is hardly ever features in economic discussion, but I think it's actually quite important. just the way industries are connected.
Just throwing something into this endogenous, exogenous debate. I've seen a very persuasive chart quite recently, and it relates crude oil price to the recession. And when you have a period of crude oil price increasing, a significantly lengthy period, the recession almost automatically follows. Any comments?
Well, I mean, if you go back to the recession of the early 70s, and the oil price rose at 4 times, I mean, essentially what an increase in commodity prices does, it temporarily transfers income from non-commodity producers to commodity producing nations. So in the early 70s, it means, if it rises, then real income is taken out of the UK and it goes to OPEC. But eventually, when they decide to use this money to spend on export policy, it sort of rebalances itself. And it's a question of the lag there. But yes, I mean, insofar as real commodity prices reduce spending power in non-commodity producing economies, it will have a tendency to dampen this down. But there's that feedback that eventually they'll spend this money. And since their own domestic productive capacity is quite small, then they'll buy from the economies with the capacity. In the 70s, they never spent it on oil, so we were quite good at producing it. So.
Yeah. In this model, what that is if I play back what I think I heard you say, is that's a sustained period of increase in this. The variable production costs push up. The industry tries to maintain its margins by pushing its prices up, but then you hit the demand limits and you're stuck with less demand and no ability to push the prices up any higher, so your profitability collapses and it chokes off your ability to justify making an investment in new capacity, and therefore you end up with a recession because now you decide actually you're not going to build the plant after all. Get that?
I think that previous question leads me to suggest that this is strongly applicable to the current situation with the commodity markets and strategic minerals. Don't you think?
That increase in their value is being driven by huge demand mostly from China, I guess, right? Which will ultimately feed through into prices, right? Oh, well, this could be a commodity sector. This actually could be, yes. This could be oil field production capacity, the demand for oil, the oil price, profitability of producing oil. Yeah, this could be there as well. But don't wait for me to ask you to say something. Just say it.
Okay, I'll jump in then. You were talking about capital-intensive industries where there was time to construct the capacity. One of the examples sorry.
Well, what I was going to say was that's where the conditions are strongest to cause this to happen.
Right. Okay, yeah. Indeed. And I think we can all appreciate how that occurs, even though you might say, well, you really ought to appreciate it. How much more perplexing then the case of insurance you mentioned as one of the cyclical industries.
Yeah.
Now, in insurance, there's a well-defined insurance cycle, which basically is a mix between the demand for insurance products and the capacity available, which of course is financial capacity, in this case, the underwriting, the ability to underwrite the risks. Now that is just a financial resource that can be, with any financial organisation, put in or taken out at relatively short notice. And yet the industry still goes through this cycle, whereby in times where underwriting rates are so hard, i.e. rising, you get increased capacity because people say, well, they're making money and they're going to put more capacity into our insurance division. And eventually the capacity gets too much, rates collapse in the way that you described, but it still goes through this. And yet there's no appreciable delay in that, and yet it still occurs.
It happens. I had a discussion with Lloyd's of London about exactly this cycle about a year ago, and I hope I get the story right. I think this is what their explanation was.
Yeah.
When conditions are good, they can all keep pushing their rates up. Their profitability rises. So in the case of Lloyd's, new syndicates can get established.
It's correct.
New syndicates can then go. They then have to go and raise the money from somewhere.
Yeah.
They don't actually have the money. They've got to go and raise the money. But that requires the other item on my list on the first slide, which is investor confidence. So if the people providing the money to the insurance market see rates are quite good this year, they'll think, looks attractive, maybe we'll invest, maybe we won't. Second year, they'll think, oh yeah, really good. Third year, they'll think, oh, fantastic, let's put money in. So the delay there is not in actually constructing capacity, it's in the build-up of confidence on the part of investors to put the money in for that to happen. The other interesting thing they noted about this is that I think they described it as a kind of overhang of overconfidence in rates. And because there's so much capacity, they start slashing their rates. So essentially the price just keeps on coming down, so everyone can actually do the deal and sell the insurance. And then this issue of sensitivity to small events happens. You get something like a Hurricane Katrina happen, or a petrochemical plant blows up or something. In the overall scheme of things, it's a pretty tiny event, but it's enough to trigger a complete change around in the conditions in the industry. But that's, as I understand the insurance cycle. But it does bring up the issue of investor confidence.
Given it's a very plausible story, my understanding is in addition to that, there are risks that, like the hurricanes, that are very long tail. Rare but big events. Yeah. It's hard to price those accurately.
Right.
I would have greater instability.
Yeah. But even so, all of those things are known. So it's not like this is people don't know what capacity is there, particularly within the London market. It is all known. Yeah.
Presumably there's some kind of game theory going on here, isn't there, about, well, shall I build capacity? Will you build capacity? The game plays out that actually we both decide to build capacity and we both end up getting stung by our decision. Is that? And I wonder if we could just widen the discussion a bit, because this is just one industry. Effectively, could we photocopy this, populate it with all the input-output relationships that Paul explained, and then connect it to the other parts of the economy? If we were to ask about employment, presumably employment would be a function of that plus that. So while capacity is being built, people are doing the building, and while capacity is in place and production is actually happening, people are being employed.
Yeah. Kevin, in the spirit of widening this discussion, what I've taken out of what I've seen this morning is that there are actually two endogenous theories about origins of cyclicality. One being the sentiment-based, and this one here, both of which are behavioural models that have the capability to explain some aspects of cyclical dynamics. And what I'm intrigued about, or maybe we should just sort of ask us a question: should we worry about it or not in our respective fields of system dynamics, nature-based modeling? How do we get people who seem to have the biggest influence in both the academic and policy worlds to even take seriously either of our fields and what we think is going on with cyclical dynamics?
Paul, you've probably got more experience than many of us in trying to persuade.
Issues there. So that, it's very difficult. I mean, it's such a different way of looking at the world, where it's an equilibrium view. Certain cycles must be caused by external shock. We all look for those. I mean, it's such a different view that it's very hard to persuade somebody who's got this view to look at another one, because these two approaches are so different.
Any other thoughts on this?
Something that's going through my mind. I'm not quite sure how relevant it is, but there's a pressure, certainly in the West, to demonstrate continual improvement in performance, i.e. profit and growth. But how would that influence? I'm trying to work out how that would influence this diagram. Because culturally, the West expects quarter by quarter improvement in results, which would affect decision making.
Yeah. That's a very good question.
Your Starbucks issue that you started on.
Sorry?
Isn't that your Starbucks issue that you started?
Yeah. There's another intriguing McKinsey Quarterly article, and it's basically asking the question: if you're trying to satisfy your investors, should you try to do so by generating higher return on invested capital, or should you do so by achieving growth? And basically, the conclusion is that there are kind of absolute limits to what you can achieve by trying to improve return on invested capital. If you've got it from 10% to 20%, where do you go next? You can get it to 40% or 80%. Well, no, you can't. The only way you can actually deliver growing free cash flows, which is what investors value, is by actually growing the business. So there's an imperative here for this to increase. There's an imperative ultimately to increase capacity, because that's the only way you're going to get growth in that. So that's why even in quite mature industries, you get people trying to rationalise competitors out of the industry, because that's the only way they're going to be able to deliver earnings growth.
The two main features of capitalist economies that distinguish them from all others are the cycles and the actual rate of growth, long-term rate of growth. And economics doesn't have a satisfactory theory of either. They're both very hard problems. Why do these economies grow? Well, we can try and rationalise it, but we don't really know why it is. Why do we get this persistent growth? Why does this particular social structure generate growth and no other one in human history has? And it's a really
and it's not driven simply because of an assumption that consumers want more?
Well, presumably people wanted more, if you're charging around hunting, elephants, or you fancied a bit more or bison,
But you had no means of realising that ambition. Whereas now we have. So.
The model I presented 2 years ago in this room actually was a sort of toy system dynamics model based on the idea that capitalist firms, when they compete, they can control costs and drive them down. In other words, increase productivity. Whereas in other systems, firms don't have that property.
Right.
There's a whole institutional argument.
Okay. Well, we're out of time. I'd certainly like to thank Paul for sparing us his time this morning and a lot of quite deep wisdom. So thank you very much indeed, Paul.